My next guest forecasted 2,600 gold by 2014. That's the last time I spoke to him was 2 years ago. He joins me again today. It's David Bensimon. He's with Polar Pacific, a financial consulting firm. David, thank you so much for being with me today.
It's a pleasure always, Daniela. Thank you. And, just to refresh for your audience with Kitco, what the big story is. Gold is in a multi-year climb. From 2001, the first target in 2014, later targets as well in 2016 and beyond. And ever since 2001, my forecast has been unwaveringly that we're going to climb tenfold increase in value from 260 to 2,600. Now, along the way, we've seen from that actual low in 2001, the actual high in 2011 as an intermediate high, but also the other intermediate highs in 2006 and in 2008, which generated some corrections. Every one of those 6 key turning points has adhered to a very interesting rhythm. And I'm pleased and proud of the fact that every one of those turning points I was able to predict in advance. But the key point is that every time the market has delivered one of those specific price and time junctures, it's added to the conviction and the confidence that we're on track to reach this 2,600 target in 2014.
Okay. So you're sticking to the 2,600. You have not changed the numbers.
Absolutely.
Okay.
And what's happened since the last time we spoke? In early 2011, the forecast was that we would have a small consolidation, minor trading consolidation, and then resume that uptrend towards 2,600. And the market rallied 50% over 6 months, which was a beautiful run. Now, as we reached the end of that summer in 2011, the market was becoming way over bullish. Everybody was suddenly lifting horizons to 2,000, 2,500. My 2,600 was looking cheap, at that time. Of course, compared to 10 years ago at 260, 2,600, most people weren't looking at. But as we reached that high at the end of summer of 2011, I did an audio program, internet radio program, which is actually very often posted on Kitco website, and said that there was identified a number of reasons, a number of elements for resistance at 1930, and called for a several hundred point drop. And a few days later, the market did peak at 1920, just a couple dollars away from the target, and fell $400 to 1520.
Right.
Now, what happened since then is that the market has moved in a very broad oscillation between 1520 and 1800, several times touching both sides of this range. And conceptually, what is happening? The market needs to react to that $1,200 gain from 2008 to 2011. And the question was whether that first drop to 1520 was enough or we needed more. There's 2 ways that the market can do a correction, because the objective is to reach the base of a channel. It's a very typical, ordinary, normal pattern of behavior for the market. Now, it can reach that channel in 2 ways. It can either fall hard and fast, very deep correction in price with a very short space of time, or it can fall more shallow correction in price and consolidate more horizontally through time.
Okay.
And there were 2 windows of opportunity for this. One was in July at the lower price, which the market obviously elected not to go for because it couldn't get below that 1520 established support. And so that opens up this window for a very powerful juncture of support in February 2013.
Okay.
Now, I just did a presentation in Vancouver several weeks ago.
But I'm going to stop you right there a second, David. Okay, so you're saying February 2013 will be key for gold?
Yeah, well, not only gold. In fact, this is one of the interesting points, is that when you look at gold, silver, copper, oil, TSX, S&P, across the whole range of markets, and for very different technical reasons, different calculations, they all point to this very powerful juncture of support, about 20% lower, roughly speaking, but all pointing to that juncture in February 2013.
Okay, but what's happening in February?
Well, this is the technical relationship between the nature of the movements that we've seen already.
Because I know last time we spoke, you said April was a critical month. Yes, I know November's a critical month, so now...
In this particular case, it's February across the range of markets. But October right now, at the beginning of October, was in fact the top of this corrective movement. And so we've already seen from 1,800 down to the current level, 1,700, the initial start of this decline. Very, very short term, I expect the next week or so we'll see a little bit of a pause here at 1,700. But during November, probably right after the election, I think that we can see the next down leg that'll take us back to 1520, and then a little bit of a bounce, and then the final down leg that'll take us to 1440.
Wow, as low as 1440. So correction to 1520, then 1440.
Yes, and the net decline from where we are now is really about a 15% percentage point movement. It's not that dramatic. It's more than a little bit, but it's not terrible. The key point is that juncture, if we do reach 1440, as I expect in February 2013, is the absolute best last buying opportunity. And the next 2 or 3 years, 2013 and 14, we're going to be almost doubling in value to reach 2,600. One last point, though, is that if we do suddenly break above 1,800 in the next very short while, well, that's all great and good. It just means that we're on the fast track toward 2,600.
Right.
But I don't think that that's what's going to happen.
Right.
I expect we're going to do the correction.
Most analysts I have been speaking to have been looking at 1,800 gold as the next key resistance level. So you don't necessarily agree with this?
Well, 1,800 is or has been the key resistance level, and my projection was that it would stop at that 1,800 as it did several weeks ago and retreat from 1,800 down to the 1,440 with a pause at 1,520. Of course, every inflection level, every resistance point or support point becomes itself a trigger to either reverse or to accelerate. Okay. So if at any point you break 1,800, that the market is telling you something as well.
Okay. David, when we're talking about gold, what are the key driving factors for the price?
Well, there are fundamental issues as well, and one of them that has given people a lot of hope has been this quantitative easing. Everybody expected that was going to deliver, a push up, and it did help to propel the market up from the lows back up to the 1,800. But that's not enough to drive this market much higher. I think also that with the elections coming, increasing probability, in fact, that the Republicans will have a good chance of winning that election, there is a growing expectation that the monetary policy might tighten up a little bit. Okay. And that would actually fit very well with my technical expectation for the down leg in November.
David, just some quick thoughts on silver with the few minutes we have left.
Sure. Silver normally on the downside tends to go 2-to-1 relative to gold, and on the upside 3-to-1. So when it's more volatile in both directions. So as gold moves toward its target 15% lower at 1440, that would be consistent with silver reaching its very important level of support at 22. And I know it sounds a little bit rougher territory to get down to from where we are now at 32. Yes, it is a little bit choppier, but you know what? Boy, is that going to be fabulous for the next couple of years going forward, because you're going to be outperforming gold by a factor of 3-to-1. So when gold doubles, silver will be going up about 6 times.
David, thank you so much for your thoughts today.
You're very welcome. Thank you.
And thanks for watching our coverage from the New Orleans Investment Conference. We'll have more for you on Kitco.com. In the meantime, you can email me any comments or questions at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.